Hello, everyone, and welcome to today's webinar hosted in partnership with Billtrust, How Top CFOs Will Win 2026, Automate, Accelerate, De-risk. We're excited you could join us. My name is Megan Billingsley, and I'll be moderating today's event. Today, we are going to deep dive into ways CFOs entering 2026 can balance growth and risk, automation, and adoption. We are thrilled to be joined by our speakers, Jacob Brunton, Nick Levine, and John Vaillancourt. Before we get started, I have just a few housekeeping items. Please note the slides will advance automatically throughout the presentation. To enlarge the slides, click the Enlarge Slides button located in the top right corner of your presentation window. If you need technical assistance, click on the Help widget located on the bottom left corner of your console. We encourage you to submit questions at any time throughout the presentation using the Q&A widget at the bottom of your console. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. Please know we do capture all questions. So to begin, I'd like to ask each of our speakers to provide a quick introduction of themselves and their work. So Jacob, how about we start with you?
Sure. My name is Jacob Brunton. I am the Finance Transformation Lead at Ahead. Previously was over accounts payable, but I've also been an accounting manager and several other roles in the past. The primary theme of my career, I would say, would be systems and process improvement. So I think the trajectory has always been sort of towards this finance transformation type role that I'm finally in here and excited to be exercising. It gives me the opportunity to find ways to improve operations and efficiencies across all areas of finance and accounting.
Excellent, thank you. And Nick?
Hi, thanks for having me on today. My name is Nick Levine. I'm an accounting and fintech consultant. I predominantly work with fintech companies that want to work with accountants for how they can make their products more bespoke and more bespoke to their needs from a functionality perspective. I'm a chartered accountant by background, and for my sins, work both in public practice, as you say, in North America, but also in industry as a financial controller and head of finance.
Excellent. Thank you so much. And John?
Yes, thank you, Megan. My name is John Vaillancourt. I'm a CFO partner at SeatonHill. SeatonHill is a national CFO advisory firm. So we have over 100 partners, most with 25 years of experience across all industries. We provide interim, fractional, and project-based CFO services, mostly for PE and closely held companies. So prior to SeatonHill, I've worked as a CFO in industry, predominantly for SaaS and tech platform companies serving enterprise clients. I'm a licensed CPA, and I live outside of Boston.
Wonderful. Well, thank you all so much for being with us. And now that we're more acquainted with each other, let's get right to it. Just to kick off, I'd like to start by asking, in planning for 2026, CFOs are focused on operational efficiency, cash flow, and risk reduction. So given these three objectives, where does AR and payment automation move the needle most? And I'd like to hear from all of you, but Jacob, why don't we have you kick this off?
Sure. I think the biggest are going to be operating efficiency and cash flow. I think by automating various aspects of the order to cash cycle, especially with leveraging AI, you can realize some significant wins for both operating efficiency and cash flow. One example would be collections automation. You can get your cash in the door quicker and more efficiently. Of course, you want to make sure that you've got those human in the loop workflows to ensure that you're not letting things fall through the cracks for high value transactions or for, customized customer and client experiences. The other place that you can realize some great efficiency and that will impact cash flow is AR invoicing. I think if you get some really good automation in on the AR invoicing side, you can improve your cash flow and reduce your DSO by getting customer invoicing accurate and out the door quickly the first time so that you don't have disputes or back and forth of you need to credit and re-invoice, and it just makes things messy and drags your cash flow out that much further. And finally, the last piece here that I'll mention is that automation can really strengthen your cash forecasting by giving you a cleaner timeline on when you can expect that cash. I think better forecasting enables smarter investment and better planning.
Nick, anything you'd like to add?
Yeah, I mean, I'd echo Jacob on operating efficiency. I think more because if you look at the range of tasks that can be undertaken by automation from operating efficiency point of view, whether that's onboarding, collections, proof of delivery, routine dispute responses, these are not value-adding tasks. This is just admin. So it's more efficient in terms of resource. No one chose to go into finance to process data, and ultimately by having sort of great sways of that automated, in particular through having tech stacks that are fully connected in terms of letting data flow, CFOs and finance teams can just be freed up to focus on more value-adding tasks. But I will caveat that with the sort of human element as well. Again, that Jacob said that for cash collection, if for whatever reason that certain invoices aren't getting paid, you still need to have that sort of human judgment brought in for more complex disputes and negotiations.
John, we'll close with you.
Yeah, I think I'm going to hit on some of the same themes, but for me, it's a tie between improving cash flow and operating efficiency. When you automate, you're speeding invoice delivery and then payment collection and therefore cash application. And using an automated tool like Billtrust, overall that accelerates your cash flow and improves match rates. And then your operating efficiencies are crucial for, reducing error reconciliation, and it frees up the finance and the AR team for higher value tasks.
Excellent. Thank you all so much. Many finance and AR staff still see AI as a threat rather than an assistant. So what has worked for you in moving change-resistant teams to a place where they trust and rely on these tools day to day? Again, would love to hear from all of you. Nick, let's start with you.
Yeah, I mean, I'd say answer the mantra. I'm not sure who said it originally, but there's a phrase which has been pushed about, basically saying AI won't replace you, but you might be replaced by someone who knows how to use AI, better than you. So ultimately, if you want to future-proof your, career, it's really important to learn how to use AI to leverage the benefits within finance. Also, for more junior employees coming through, it's a great way for them to sort of shine and stand out and progress their careers, faster. And the question is, how can you use this in a genuinely value-adding way to move away from these sort of routine admin tasks? That said, in the first instance, it is important to have your underlying processes nailed down, because if those aren't well defined and efficient, AI can only replicate that as well as what you already have. And ultimately, it's saying to finance teams, utilizing AI can allow you to sort of move on to higher value activities, whether that be the payment collection side, if they're in AR, negotiating in terms of more on the commercial side, and also customer relationships. I don't think AI can replace that human side, and AI allows individuals in finance to make themselves more valued, in the relationship piece, and ultimately, customer experience that can align really well to with sales to reduce churn and add value. So if you can use AI to have a really compelling customer experience for how your customers pay their invoices, you can add value there too. So I'd say AI is something to be excited about and champion.
Yeah, I think to dovetail off of sort of the theme of what Nick was saying there at the end, it's really important to help them elevate their position in their own mind, right? Because AI can help to free them from what might seem like a prison of monotony in their just day-to-day repetitive grind. And you can paint a picture of their future role in an elevated capacity where they are freed up by AI to do things that are much more strategic, much more enjoyable, much more challenging, right? And I think most employees do want more of a challenge. And so there's certain things, like Nick said, that are relational in terms of like building customer relationships and being close, keeping a pulse on their customer accounts, like, helping to resolve discrepancies between like the customer purchase order and the invoice. And maybe as you do that and you build a relationship with your customer, you'll start to notice trends of, oh, hey, for this particular type of product or this particular type of service, and with this customer or these types of customers, we keep running into this same type of problem. Now you're in a position to identify a systemic problem for the company that you can work with other team members and other teams to fix, and you're adding that much more value. So there are lots of ways that an AR team, any team, but here we're talking about AR. There's lots of ways an AR team can elevate their position and their role by giving some of the monotonous daily grind to AI. And I think it's just painting a picture of that for them so that they have a vision of what is possible in their future. They've got something positive to look forward to rather than worrying about the negative of AI is going to take my job.
Yeah, I think from my perspective, I mean, AI, it's scaring a lot of people, but it's important to remember that AI is a tool to augment and not necessarily replace them. So a lot of great points have been made about staff, embracing AI, really eliminating the monotony, the boring work. That's huge for young professionals who, will end up doing a lot of the route work early in their career. So when they see that automation and a pathway to more higher value tasks, that gets them excited. But some of the blocking and tackling to make sure that these initiatives go off well, leaders really need to be transparent when conceiving and launching the AI projects. And you need to get buy-in early from the team, right? Involve the staff in defining the automation rules, building trust and ownership and comfort with AI. Those go a long way towards, getting full buy-in and, excitement on the team and eliminating some of the fear about what it means to their role in their career.
Yeah, I think that's a great point about the having the full buy-in and needing that from the entire team. John, I'd like to stay with you for this next question just to kick it off. As AI takes on more AR and payments decisions, what governance practices such as auditability, model oversight, and human-in-the-loop controls should CFOs prioritize to keep the organization compliant?
Yeah, I mean, I think there's some core principles that still need to be applied, even when you're moving to AI automation solutions. And those are key things like, maintaining audit trails and transparency by logging actions under the user's automation identity. And, you'll hear a lot of discussion of keeping a human in the loop, particularly for exceptions and high-risk transactions, and to track the model accuracy. Right, a lot of these new A models are still somewhat experimental, so you want to track the accuracy, manage error rates, and then be on the lookout for kind of false positives or false negatives, and then just ensure strong data governance procedures using clean, reliable AI inputs. Things like invoice history, payment dates, credit history, and documenting the data lineage. So starting with clean, fresh data makes it easier to track and monitor the outputs from AI engines.
Excellent. Nick?
I was actually thinking about this through the lens of onboarding and ongoing compliance, as that's one of the riskiest areas. By all means, it's important to use AI to support processes around anti-money laundering, credit and risk checks. But it's important to have that sort of human judgment for high-risk customers as well. Sometimes AI can be really good for flagging an anomaly. You do want to have checks and balances in place that anything which is flagged as a sort of high risk, that a human can go and look and interrogate that. And in terms of the sort of general invoices, if an invoice is particularly large from a new customer, sometimes it's something that looks too good to be true. It can be, so it's always worth checking that. And going back onto John's point, it is important to have every action auditable. So if something does go wrong, go back and see where the error was. Was that a human judgment? If so, how can the organisation learn from this and stop it happening again? Or was this automation that failed in sort of one instance? But also, I think it's important to think about the security of data as well. So just in terms of stopping any sort of data leakage, being misappropriated, it is important for organisations to consider strong security standards, whether that's be for North America, SOC 2, which is the sort of gold standard, and for Europe, ISO 27001, which if you check on the sort of AR and AI tools that you use, make sure you've got these credentials in check so you can make sure that your customer data is secured, because that's just going to back you up from a compliance perspective.
Excellent. Thank you. Jacob, we'll close with you on the CFO's focus here. What would you say?
Yeah, I think one of the biggest things is the human in the loop principle with AI. And so I think there are ways to build AI workflows that accommodate that more than other ways, right? I think it should be really easy for the AR specialist or whatever the human in the loop is for the role to be able to see what has the AI done, what is pending my review and approval. And it should be really easy to review, here's what the AI flagged as a medium risk, here's what the AI flagged as a high risk discrepancy, right? Have the AI review its own work, give you a confidence level, give you flags for things that are more or less likely to need review, make the user experience really rich and easy for the specialist so that they're able to do their job well while not eliminating the value that you're getting from the AI, right? That's the real trick, is getting this governance and auditability and risk oversight without slowing down the operations and reducing the tool's overall value.
Excellent. Thank you so much. Now, let's say that a CFO could only automate one part of AR first. Which step in the process usually delivers the quickest and most visible impact, and why is that the case? Jacob?
I'd start with electronic invoicing on the front end and probably automated reporting on whether the invoice was delivered, right? Because you've got all kinds of portals that you have to submit AR invoices to, at least we do. And I think that's probably the case for many others. You've got outdated email addresses for your clients. Maybe they've gone through an acquisition or an org change or something, and the address that you had on file isn't where the invoices should be sent anymore. There's all kinds of possibilities for losing invoices, invoices get lost in the cracks. And so having the invoicing both automated and having a way to report on confirmation that yes, the client received it, I think is going to be huge. And that gives you the foundation to prevent downstream issues with the rest of the AR process.
Excellent. Nick?
I'd say going with payment processing, just because anything you can do to get cash through the door faster is, from a sustainability point of view, is going to help. So I was thinking about things like, ultimately, it's just about creating a really rich and compelling, easy customer experience. We talk a lot about, internal automation in finance, but how can you make automation easier for the end customer to pay their invoices? Ultimately, finance teams are generally sort of stretched and don't have time to complete all their tasks at any one time. You can just make it really easy for customers to pay their invoices. That's going to get cash through the door faster. So what I mean by that is ultimately invoices having a range of payment options, whether that's wire transfers, debit or credit cards, virtual wallets, or flexible finance. You can advance them perhaps like a credit line. Ultimately, that just makes it easy to people pick their preferred method. If you can make that accessible through a portal on a range of devices, it just makes it really easy for customers to sort of make that transaction and complete it as soon as they receive it. So ultimately, it's just about giving that really sort of rich and compelling customer experience, giving them automation for when they pay their invoices, just to get that cash through, just get the cash through the door faster. Get your DSO down.
John, what would you say about quick wins, quick results?
Yeah, I mean, companies are different, but there are some common themes across companies. But I think first, each situation, you got to look at the lowest hanging fruit. So where's the highest volume of manual work where results are measurable? So doing that, is going to build credibility before getting into the more complex areas like collection analytics. So for many companies, like Nick said, it's cash application and payment matching. That's where a lot of companies struggle to really apply that cash. It can really be time consuming. And then, to Jacob's point, a lot of companies are still sending paper invoices. So you're slowing down the collection process right from day one. You want those, on electronic delivery. So for me, I'd recommend prioritizing the cash application and payment matching, and then move on to the electronic invoicing in most cases.
Excellent. Great things to keep in mind as you are starting off the automation journey. I'd like to ask, from your experience, what are the 2 or 3 metrics you watch most closely to judge whether AR and payments automation are really paying off? Nick, we'll start with you.
Ultimately, the key one has got to be DSO, day sales outstanding. In particular, we're now living in the age of sustainability, where there's a bit more pressure on downward valuations of companies. So to be sustainable and get cash through the door as quickly as possible is become more important than ever, to increase time between funding rounds. So I'd say ultimately getting that down to minimal being the key one. But also bad debt write-off ratios are equally important, I think, because that really indicates that a relationship is deteriorating. So if it's a customer that's not paying an invoice, that potentially has implications for future invoices as well, and on your future cash flows. But also, bad debt and write-offs require that sort of human intervention. And from a resourcing point of view, you want to sort of minimise the instance of your finance team having to get involved in those sort of disputes. Obviously, you have to do that where it's necessary, but it can be a real drain on resource, and in particular, if you're not going to recover them, that's potentially wasted resource as well.
John, what would you add?
Yeah, I mean, I agree with Nick. I think, the core metric around receivables is, the DSO, the gold standard, day sales outstanding. You really, it encompasses all the other elements of the process. So that's the most important thing, right? If you're sending out invoices with 30-day terms, if you get your DSO anywhere near 30, you're doing well. So, and then I'd also watch the match rate, right? It's important managing the payments and how much posting automatically. Again, as I mentioned earlier, that can be a significant area for kind of manual rework and a lot of manual intervention. So it indicates a lot of efficiency. If you've got a high match rate in the high 90s, that's a great automation process you've got in place. And then ultimately, right, AI is all about kind of reducing staff and labor cost, allowing those staff to take on higher value adds. So if you're watching your collection and AR, labor costs go down and repurposing that staff, that's huge, right? That's what the CFO is charged with, automating and reducing the cost for just route things like collections and AR processing.
Excellent. And Jacob, we'll end with you here. What are the metrics that you're keeping an eye on?
Yeah, I think obviously DSO is definitely the gold standard. I'd say maybe auxiliary to that would be taking a look at your collection or payment delay reasons. Are you noticing that a lot of times you're getting disputes because of PO versus invoice discrepancies? Or is it, customer just not responding? Or are there other issues? Maybe there's some CSAT issues. I think tracking the reason, capturing, first of all, the reasons in a structured way that you've got delayed payment, and then tracking the volume and the trends of those reasons over time is going to be really helpful to identify what are the root causes here. And then maybe at a very high level, you could look at your cash forecast accuracy, the 13-week rolling cash forecast. You could compare what was forecasted versus what the actual was, especially from a receivable standpoint. And that will give you the data to start to identify other metrics that are potentially things that you should be tracking and trends that you could start to dig into in order to identify, where are our easy wins here in terms of improving our overall cash flow.
Important to note, all three of you mentioned DSO, so definitely one of those key metrics to keep an eye on. Thank you so much. Now, you've all seen automation projects that turned into shelfware. So what separates automation that sticks from automation that quietly dies after launch? John, we'll start with you.
Yeah, no, it happens so often, and it's a great question. I think you have to start with clear business alignment and define use cases so automation solves a real pain point, with measurable impact. And it's critical to maintain, executive sponsorship throughout. If leadership checks out, then momentum and decision-making stall. And then you need strong change management that helps control inevitable requests for customization or new integrations. Without it, you've got scope creep, delays occur quickly and potentially derail the project. So, and you also want to focus on early wins to build, small successes to build confidence and momentum for the longer, more complex phases.
Excellent. Jacob, what are your thoughts?
I think it's really important to map out your processes beforehand and do it in very minute detail. You want to document the full order to cash process. How does sales flow into sales ops? How does the data reach the ERP? What are the invoicing rules for different products and different customers? I think without that very clear and detailed documentation, everyone sort of just relies on tribal or legacy knowledge, and those things won't get captured in the solution that you're designing with AI or automation. And if you do the hard work on the front end to make sure that you do capture those things, you can present that to the team to give them assurance. Like, look, we've thought of everything. We took all of your input about your current ways of doing things, and we didn't leave anything to chance. We documented everything. There's no exceptions and things like that we haven't accounted for here. And we've built the system around that to accomplish the same goals. And now you don't have to rely on this tribal knowledge anymore. You've got comfort and confidence knowing that the system is going to do what you need it to. Because I think that's a big fear, in addition to what we talked about earlier in regard to, am I going to be replaced? Another big fear for adoption is, do I have confidence that the system is going to do it right? Right? I know my job is what a lot of people are going to think. I know how to do this. There's so many different variables that need to be thought of. Did they take all of this into account when they built out the system? And so if you can answer yes and give them that confidence, I think that is huge in terms of making sure that they adopt it and they feel confident in moving forward with it.
Excellent. And Nick, what would you say about successful adoption?
Yeah, I'd say it's really important to have buy-in and champions to raise awareness, both at the functional level, but also from the executive level as well. I think that holds organizations accountable, but also, quite often to put these projects into action, there requires a fair amount of business partnering. So it's important to get the wider business on side, so they can sort of provide information and collaborate in a timely way. And so it's important to have the communications charter around that from those champions, sort of let people know from the offset why you're doing this, keep them in a loop with how things are going, and then hopefully then if you do have that success, celebrate those successes to so that those that have integrated projects can take some of that limelight, but also to encourage further business partnering as well, so that whether it be that automation project or future ones are successful. And then in terms of what those benefits have been from success, share that. If it's time saved, has that allowed certain individuals to sort of move more up the value chain in terms of the tasks they're doing? Has that cut costs? And ultimately, it's important for automation projects not to be like siloed in a box within an organization. It's really important to make that awareness immersive, to bring everyone on the journey with you, and to boost business partnering efforts, which will increase the chances of success.
Great points, all of you. Thank you so much. Jacob, we'll start with you on this next one. As operations become more real-time, what's one control or risk practice that has to change to keep fraud and compliance in check?
I mean, I think there are a lot of ways, importantly, to mitigate risk, but I think a lot of it starts with customer onboarding. It can be a very messy process because you're trying to coordinate between sales, legal, sales ops, potentially finance. Everybody sort of has a piece of the puzzle when it comes to onboarding new customers. And if you don't have clear definition around handoffs and responsibilities between those different teams, it can fall apart really quickly, and you can leave yourself open to some significant risk there. Another thing that makes it complicated is the fact that you might have different risk profiles or different risk mitigation strategies for different lines of business or products or services that you offer. And so it could be that you're onboarding a customer for a particular opportunity with a particular type of product or service that requires one type of review by legal, by finance. But the question is, are you potentially going to cross-sell that customer on another type of product or service that requires a completely different type of review by legal or by finance? And are you going to do all of that review for all of your offerings up front before you onboard the customer for this single opportunity? Or are you going to find a way to track that, okay, this customer's only been onboarded for X type of service or product, and if we want to cross-sell them, we're going to need to go through the additional process of checking for the risks associated with the other types, right? So there are some really complex and heavy decisions to be made cross-functionally across the business at the front end, and you just need to get those decisions hammered out and documented, and then have a plan in place to achieve it, right? So you want to make sure that your system in your workflow is going to allow for the robust checks and balances that you need at the front end when you're onboarding a customer, and that it's being captured the way that it needs to be captured, and that you're not slowing down the sales cycle, because that's the other risk there, right? You want to make sure that you're covering yourself from a fraud perspective without causing CSAT issues and without slowing down the sales cycle and slowing down your sales engine.
Excellent. Nick, what would you add?
I'd say the same as Jacob in terms of onboarding. I think there's just the expectation now that customers expect this sort of things to happen very quickly and to be onboarded in this like instantaneous manner, because as consumers and automation, everything we tend to do as consumers is instantaneous, and so now people have that same expectation from a business transaction point of view. But obviously, that sort of carries risks. You need to make sure you implement those sort of process around sort of compliance and checking. So what I would say is, by all means, you need to leverage the automation efficiencies from anti-money laundering and credit checks. But also, I think it's important that the profile of customers can change. So rather than looking at onboarding as a sort of a one-off exercise or even a once per year exercise, ideally want to use automation technology to make it almost like continuous, because the circumstances of companies can change in terms of the risk profile. Whether that be if they incorporate entities in new jurisdictions which carry higher risks, whether they have negative media coverage or individuals that become politically exposed. It's super important that checks should be robust, but those should be having an ongoing monitoring system as well that's constantly going on in the background.
Excellent. John, what would you say about keeping fraud and compliance in check?
Yeah, and I just pop it up a level, and you asked for kind of one example or one risk. So I go back to some core tenets of finance control. So, automation can change the game and blur the manual handoffs, but it's still critical to have, segregation of duties within the digital workflow. They need to remain essential to prevent undetected errors or omissions. And again, with high automation, keeping a human in the loop to review those exceptions and any unusual patterns, that requires manual review. So again, proper segregation of duties, humans in the loop, and monitoring are key overall for fraud and more compliance.
Excellent advice, all of you. Thank you so much. How should a CFO communicate their AR and payments AI initiatives to the board and other stakeholders so they're seen as an innovator, not just a cost cutter? Nick, what would you say?
Going back to my point on sustainability, I'd communicate that it's important to put these automation processes in place just so businesses can continue, to operate. I'd say that AR automation is effective as it helps generate cash, get paid faster, and ultimately reduce bad debt. And by having more cash in the bank, that creates more options, whether that be hiring new employees, whether that be entering new markets to increase your footprint there and potentially increase the value of the company in the future, or developing new products. These are all things where these can help increase the potential revenues of a company over the longer term, and so can help increase valuations, which ultimately will be good news for investors to hear. And also, we were talking earlier about forward-looking forecasts, that if you have better grasp on your AR, your forward-looking forecasts are going to be more sort of accurate. It'd be better to rely on those forecasts. And going back to also the commercial piece is that AR automation can reduce customer churn, which adds long-term commercial value. If you know that invoices are more likely to be paid and on time, you potentially look at ways of increasing the value of those accounts and how those would look to being built out in the future. And ultimately, I just say it comes back to the point of valuations. If that can help increase valuations due to reducing your burn rate and increase and using that investment to increase value of the company, it's not just cost cutting. You can change the conversation and say this is actually about growth.
Excellent points. John?
Yeah, absolutely. So I work with a lot of boards of directors and investors, and they're very aware of the impact of AI. So I think for the CFO, you really need to frame it as strategic growth, right? We need to highlight the benefits, like faster invoice to cash, better customer experience, and scalable growth. And the boards, right, they're always looking at ROI and returns. So if you can demonstrate as CFO that, say, you're going to cut your DSO by 3 days, and that may free up $5 million in working capital, that's money the investors don't have to put into the business. So I think you emphasize risk mitigation, compliance safeguards, which resonate with the boards, right? They don't want the company getting sued. They don't want to be personally sued. So build slowly, demonstrating some of the earlier wins to create alignment for larger projects. But boards and CFOs, who are strategic and focused on growth, demonstrating how these AR automations and others can help a company grow while keeping a lid on payroll cost, that's music to the board's ears.
Yeah, very well said. Jacob, you'll have the last word here.
Yeah, I think echoing both Nick and John there, I think highlighting the tangible impacts, especially the improved cash flow, decreased DSO, I think that together is going to drive valuation. Of course, that's what the stakeholders are looking for. I would also emphasize customer satisfaction, right? When you automate things, especially invoicing, you're decreasing the chances, ideally, of invoicing errors and invoicing discrepancies and things like that, and that can lead to some significant upticks in customer satisfaction. And having happy, reliable customers is going to improve your DSO and your cash flow, and add strategic value. I think you're also going to be able to identify where you've got opportunities to, like Nick said, increase business with really good customers who have good, reliable cash flow or provide that good, reliable cash flow to the business. And I think that's going to be a huge value add.
Excellent. Thank you. We're nearing the end of our time, but before we get to some audience questions, I do want to ask one more just to kind of wrap up our discussion here. If a CFO has decent systems but no clear AI strategy yet, what would you say is a sensible first 90-day action plan that doesn't require ripping and replacing their current stack? John, we'll start with you.
Yeah, it's a good, great question, because everybody's looking for, where to jump in and where to start. So for me, for the first 30 days, I conduct a quick value assessment. So map the AR workflows, highlight the pain points, highlight where are the manual hours, where are the exceptions occurring, and then benchmark your metrics, how they exist today, DSO, match rate, cost per invoice. And then over the next 30 to 60 days, run a pilot automation use case in one particular area, whether that be cash application matching or, and do it with a vendor in-house. Define your success metrics, prepare the data, and track results. And then you build the user adoption path, gather the feedback, and adjust processes as needed. Establish the governance, data quality controls, and change management to support scaling. And then based on those pilot results, you can expand the automation if you're ready, or pause it if the team needs, if the team and the process aren't aligned and ready, ensuring a gradual adoption. So that's how I look at the, first 90-day assessment to get started.
Excellent. Jacob, what would you say?
I would suggest taking an iterative approach. So the rough outline would be the first 30 days would be organizing and structuring data. What I mean there is you can leverage AI quite a bit to identify where your data is out of sync between systems and organize that data. Run free open text notes fields through the AI, have it categorize it and structure it for you, and then build that structure into your system so that it's part of your systematic workflows. I think that's some good, easy wins that you can do in the first 30 days that will set you up for success down the road, right? So in the first 30 days, you're organizing and structuring data, and you can use AI to do that. The next 30 days, you're streamlining processes around that newly structured data and identifying where are our quick wins and where are our long-term heavier lift projects for AI, so that in the last 30 days, you can begin to implement tools. And I like what John said of start with something easy in terms of implementation. You can start with a quick win in terms of implementation while you're making plans for those heavier lift projects. But if you've done that initial organization and structuring of data and streamlining of processes up front, that really sets you up for success when you go to implement new tools.
Excellent. And Nick, your first 90-day recommendations?
Yeah. So I think we're quite well synced on that. The three of us are quite well synced on this. I mean, the first 30 days, I'd really look at your sort of current tech stack and systems and processes and really just try and identify where are their weaknesses, just simple things like connectivity. If there's like a broken connection somewhere, for a quick win, is there an AI vendor that can just plug that gap easily and, really have that sort of, productivity win. And if you've identified a use case for that or several, for the 30 days that follow, I'd look at piloting different integrations, ideally just within a small subsidiary or test environment. So if your organization has got a number of the subsidiaries, I just picked the smallest one to minimize risk and to sort of separate that experiment from the rest of the organization, even though it's a real live test environment. And I think to understand the chance of success, it is important to define related KPIs, the obvious ones we've spoken about, like DSO and bad debt write-offs, and just try and track progress and see from doing this sort of little test experiments, are those metrics increase? Are those metrics improving? And for those integrations during this 30 to 60 days, are there sort of training needs among the wider team? If so, get them all trained up so everyone's singing from the same hymn sheet. And then from the 60 to 90 days, I'd say start looking at the results. Look at those KPIs. How do those KPIs that compare with the sort of the wider organisation? If that's gone well, can we look at sort of rolling this out across the wider group? And ultimately, if that success has gone well, within the next 12 months, look at whether you can implement it across the entire organisation. And ideally, that the goal is using AI to aim for end-to-end automation. So that should be your nirvana if that project has gone well.
Yeah, great advice, all of you. And I really like that point about starting with a smaller subsidiary first. All right, so in the time that we have left, I would like to turn to some questions from our audience. A reminder to our viewers, if we don't get to your question today, we will respond by email. So Jacob, Nick, John, feel free to jump in as you like. Our first question asks, how has automation improved your visibility into the next 13 weeks of cash flow? And can you share a decision that it helped you make with more confidence?
I'll kick off with that one. This is more what I'm hearing anecdotally from other CFOs, fractional CFOs, that one really recent innovation that has helped with 13-week cash flows in terms of accuracy and producing them quickly has been the rise of AI no-code platforms that basically they give you sort of better visibility into 13-week cash flow cycles. And it becomes easy to interrogate them through natural language interfaces. So what I'm seeing is it's possible to integrate financial data into Google Sheets, bringing your banking data and invoice data as well to automate categorization. And then once all that data has been sort of centralized into one place, using LLMs to create prompts to understand issues. If there is an invoice being paid late, is this likely to be a one-off invoice? Is this a recurring one? If so, how can you update those forward-looking 13-week forecasts to have that greater accuracy? And one fractional CFO that I've spoken to that's been doing this, it's got a number of clients, and they're telling me that to build this model with this no-code platform, I think it took them about 15 hours, but then to conduct the monthly 13-week cash flow outlook for each client, it was only taking them 15 minutes, where it's previously taking them 2 hours.
Yeah, and I can chime in. I mean, so what I've seen with the automation on the 13-week cash flow, in addition to Nick's points, is really, it allows you to really pinpoint what's actually happening with the historical collections for your customers. And so you can use that for more accurate prediction going forward versus general assumptions. Typically, the 13-week cash flow is relying on general assumptions about collectability, and things typically go off the track. But the automation allows more specific information across the clients for more accurate cash flow forecasting.
Beautiful. Our next question then asks, has automation changed who owns part of the cash cycle, like sales, AR, or risk? And how did that shift affect collaboration across teams?
Yeah, I guess from my perspective, I haven't seen a significant shift in the duties and who owns those parts. I think it's more nuanced now. I think ultimately finance and accounting still perhaps has significant oversight and interaction with these other areas on that cash, collection cycle. It typically falls on finance, to collect and then go up the food chain to clear any obstacles that are in the way. So I haven't seen a major change there yet, but again, we're early in the cycle. Perhaps others have seen some shifting of duties in the functional areas.
Nick, Jacob,
I would say I haven't. I'm sorry. I would say I haven't seen any shifting of duties specifically, like John said. But I would say that one change that I've noticed is the increased automation definitely requires increased collaboration between all parties that are involved in the sales cycle or the cash cycle, right? So whether it's sales or sales ops or AR or collections, that automation intertwines all of those steps in the process in a much more intimate way, such that if you don't get something right on the front end, it's going to impact those other teams downstream more significantly, or it's going to stand out more because of the automation not flowing the way that maybe teams expected it to when they would do things manually and sort of account for slight variances or differences during their manual work versus the automated flow.
Nick, any final thoughts to add?
Yeah, I haven't. I mean, watch this space, but I haven't seen it shift yet. But I guess we're, in terms of these changes, we're probably relatively. Although these changes are quite immense, I guess we're quite early in the adoption cycle in the grand scheme of things.
Excellent. All right. Well, that is all the time that we have today. I'd like to thank our speakers, Jacob, Nick, and John, for a great discussion today. We appreciate you sharing your insights and expertise with us. And of course, I'd like to thank our audience for joining as well. We hope to see you again soon. Have a great day.
So long.